5 seconds to the open. Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to this week's edition of Follow the Money Weekly Radio. So glad that you're joining us all around the world. You can find us online at followthemoney.com. Right there, you can find all kinds of free information, lots of free podcasts, videos, articles that we've done over the years to help you improve your finances, to help you create a new income stream, to help you learn how to trade. In fact, that's what we're going to be talking about today. It's a pretty fun topic, is stock trading. You know, with the markets on a tear right now and Bitcoin and, Ether and all of these different cryptocurrencies all rising and the stock market rising, I mean, it has really been quite a year for traders here in 2017. And today, what we're going to do is we're going to play you an excerpt from a recent lecture series that I do for all of our trading members, the members of our website. And every single Tuesday and Friday, I do a live teaching and training. We go through the markets. We talk about what might be happening, think good things to trade, good stocks to focus on, ETFs to focus on, but we also do lessons. So just over the past few weeks, we've talked about how to spot a head and shoulders trend reversal pattern. We've talked about Nicholas Darvis, who was an old-time trader back in the 1950s, 1960s, who turned $3,000 into $2 million in less than 10 years. We talked about that. We talked about U.S. solar energy stocks and investing in water stocks. And one of the latest coaching calls that we did with our traders was something that I really wanted to share with our general audience because it's something that I think will really help you, even if you're not a member of our website. Just knowing some of this information that we're going to share in today's podcast is so vital. So, just a few days ago, for all of our trading members, we did this live teaching on the 5 trading pitfalls to avoid. There's so many things that people can step in when they're trying to get started trading that really kind of messes them up or wrecks their trading business or wrecks their hopes of trading. And we're going to share 5 things that you really should avoid on today's podcast. So, if you listen to this podcast weekly and you say, gosh, I wish there was more. I wish there was more that I could listen to. Well, we do have for our members, as I mentioned, every Tuesday, every Friday, we're live. We're talking about things that are going on in the markets, things that would be impacting your trading. And of course, we do a lot of other stuff with our members as well. But if you want to become a part of that, if you want to get access to teachings like this on a regular basis, they're all on demand. So even though if you can't make them live, they're all available for you later. So if you want the actual video that goes along with the lesson that you're going to hear today, just become a member. Go to ftmdaily.com/subscriptions, or just go to our website there and click on the plans and pricing button, and you'll be able to learn all about our different services. All right, but let's go ahead and dive into this very special excerpt from a recent trading coaching call on the 5 trading pitfalls to avoid. And when we're done, we'll come back and we'll be joined by Tom Cloud with an update on precious metals. Today we are going to be talking about something very powerful, I think. We're going to be taking the first little bit of our call today, and we're going to be focusing on 5 trading pitfalls to avoid. I have, over the course of time, I've coached, I don't know how many traders, how many hours of trading coaching, and I've heard so many different comments from so many different people when it comes to trading. And I was sitting down the other evening, and I just sketched out some of the trading pitfalls that I can recollect, the ones that I really just see mess people up. And I wanted to go over 5 of them this morning. Later in the call, we're going to get into some charts. We're going to chart the markets a little bit, see what's happening. And then we're going to go over some of our latest trading ideas and see how those are performing. Let's go ahead and begin now with the 5 trading pitfalls to avoid. And again, when it comes to trading and traders in general, oftentimes there is an allure about trading. It is this concept or this idea that somehow trading is easy. It's a easy street life, that you can make excessive amounts of money very fast, that you can be so smart that you never lose, right? You have all of these really bad misconceptions about trading. And the fact is that much of that is actually true in an isolated setting. It is true that there have been people who have made a massive amount of money speculating in the market. It is true that, many traders have a lot of money and they can do whatever they want to. It is true. But it's also true that that there are a lot of people who've tried trading, right? And they've gotten out there and they haven't had the knowledge, they haven't had capital, they haven't had this or that, and they go out there and they fall on their face, right? And so it's important to realize that trading is just like any other income stream that you're ever going to try to create. You're going to have to approach it with wisdom, right? You would not start a brick and mortar business, right, without a business plan, right? And you wouldn't go out and start a brick and mortar business and take out loans without having a marketing plan, right? I mean, you just wouldn't do those kinds of things. But when it comes to trading, people feel like they can just go in without any money and without any knowledge and without any training, and they think they can just do it because, you just buy it for a penny and sell it for 2 pennies. I mean, it makes total sense. Well, that's true. I mean, again, all of those things can be proven true, but in reality, without proper training, without capital and all of this, trading becomes a very difficult way, right, to make money. You've got to understand some key concepts. You've got to have a few wisdom keys in place. So the very first, and as you see here on the screen, the very first problem, pitfall that knocks traders out of the game very early is a lack of capital. When people ask how much money they need to position trade, right? If you want to be a position trader like me, I mean, I'm a position trader. I take positions in ETFs and stocks that are forming new breakouts, typically around the 200-day moving average. And I will go top down looking for industries, looking for sectors that are particularly strong, and I will ride those trends as a position trader. At times, I'll also swing trade in the fact that what I'll do is I'll step in the middle of a big uptrend whenever there's a trend deviation, when the price moves down in the middle of a big uptrend, maybe a big sell-off or something, but the uptrend is still intact. Well, those are great times to swing trade, right? So the swing trader gets in and, he's able to ride that trend a little higher. But I prefer, if you ask me honestly, I prefer the position trading because I don't want to have to trade over and over and over. I don't like to overtrade, right? That's part of the reason why over the years I have come down to really focusing upon 2 primary times to be really watching the market. Every morning when the market opens, usually about 30 minutes beforehand and up until the final 30 minutes after the market's open, that whole hour, I typically am looking at the markets, watching any major headlines that are coming out, watching any economic data. The jobs numbers, in fact, came out this morning, along with some other economic data. And then during that first 30 minutes, I do not look to buy. I do not look to buy. I look to sell. The first 30 minutes, I look to sell. So oftentimes, if I wanted to take gains on something and I didn't do it at the close the day before, then I will sell in the open, the first 30 minutes. So the first 30 minutes of the market, I like to sell. I don't like to buy, I like to sell. The reason is because you have so much pent-up emotions overnight, lots of orders that got entered late in the day or just right after the market closed and it missed. So all these orders come flooding in the first, minutes of trading. And it creates a flurry of activity that often pushes stocks up, which makes it a good time to exit a lucrative position, right? Something that you've had good gains in or whatever. Oftentimes that first 30 minutes can be great to sell. But over the years, I've kind of noticed that I really focus upon that last 30 minutes. And I've learned this not just from other great traders and, people who are literally institutional investors, hedge fund managers and whatnot, people I've interviewed over the years, many of them all say the same thing, guys. There's not rocket science to this stuff. It's not rocket science. It's just tried and true wisdom, And that last 30 minutes is when the institutional players, every last 30 minutes of every market open and close, last 30 minutes before the close, that's whenever the big money starts moving around. And if you don't believe me, go look at a chart of price and volume over the course of a day, and you will see that it looks like a big U in the volume. The opening of the day, there's big volume, and at the end of the day, there's big volume. Typically, the volume in the middle of the day, or between those 2 points, is fairly muted as compared. So there is something great to know about the first 30 minutes and the last 30 minutes of every trading day. At the very end of the trading day, that's when I like to take new positions, right? I like to take my positions toward the end of the trading day. Now, when someone says, I want to be a position trader, how much money do I need to have? I really believe that to really be an effective position trader and depends on your goal. If you mean a position trader to be, a full-time position trader, to quit your job and just do position trading, well, you need a lot of money. Okay, you need a lot of money. But if you're just saying, look, I want to position trade, but I don't want to be dumb about it, right? I don't want to get eaten up with costs and slippage and commissions and taxes. Now, how much should I really realistically start with? I would say $10,000 for a position trader. Now, you can go lower. If you're going to focus strictly on options, you can probably get away with about $2,500 initial capital. But I tell you, that's really tough. You don't need as much money to position trade as you need to swing trade. So for those who want to swing trade or those who want to day trade, for example, you need a lot more money. And the reason I say this is that if you want to be successful, anybody can swing trade. You can have $1,000 in swing trade. But the commissions, the taxes, the slippage, this is going to eat you alive. So a small trading balance is fine if you're a position trader. But if you're going to be in and out of the market, you need a big balance. So for swing traders, day traders, people who want to trade very actively, maybe anywhere from 5 to 10 trades every month, you need at least $25,000 to really get ahead, right? Now you can do, if you're going to focus only on options, you can get away with a little less. But I tell you what, the lack of capital is one of the most frustrating problems for many traders. And this is why we created our 5 levels of financial freedom, is that, you really got to have enough money to be able to speculate. Now, if you have money in a 401k or an IRA, it's locked away, right? You can't do anything with it. So you might as well put it in some good, assets and some good stocks or funds or whatever the case might be. And you can always use those accounts for trading, right? And that's a great way to boost your retirement account, is once you've learned how to trade, take that IRA or that 401k and begin to soup it up with some good returns, using your knowledge. But again, number one has to be, absolutely without a shadow of a doubt, one of the biggest trading pitfalls is people don't realize, they aren't told that they need money, right? This is a money game. Trading is a money game. It's not a game of smarts, right? It's not a game of chess. It's not a game. You cannot beat Wall Street. You cannot beat Wall Street. You can only beat yourself, right? You can only beat what you're able of doing. And you're never going to beat Wall Street. Don't ever think that that's ever going to happen, right? Everybody should know that the game is rigged from the very beginning. Everybody knows that. Most people should know that. It's rigged, right? It's totally rigged. Now somebody says, well, why would you want to trade in a rigged market? Well, every market that you can imagine is rigged, right? So it really doesn't matter. You take your pick. But you have to have an understanding that that market is rigged. And those guys on the other side of the screen, they know what they're doing, and they see you coming a mile away if you don't know what you're doing, right? So lack of capital, big pitfall that will drive many people out of trading. And some people will say, trading doesn't work. I tried it and it just doesn't work. I've heard that from people, not very many, but a few. And every single time they haven't had very much money at all, right? And they're never going to get ahead if they don't have enough money. So here's my advice is that if you don't have enough capital to get started, but you're itching to get started with trading, then you can focus on options. We'll talk about that in just a moment. But let me just say this again. Position trading, you need less money necessarily than you do for swing trading or day trading because of the excessive amounts of trading that you'll be doing as a swing trader or a day trader. You just need more capital, right? So that's number one. Let's take a look at number two. This is a biggie. In many of the coaching sessions I've done with individuals over the years, one of the very first things, and this is usually what you'll see from new traders, there are not a whole lot of, in fact, I can tell you this, there are no big traders that I know, except for one, that deals in penny stocks. Out of all the big traders I know, and I'm talking guys who make big money from trading the markets, I know of no one who buys penny stocks to make their money. I know one guy who shorts penny stocks, but he never buys them. He just shorts them. And they can be great for shorting. I mean, penny stocks, how many percent of them end up going out of business? Like a huge number, right? So shorting penny stocks is actually kind of a high probability game, right? That's pretty good. It's still very risky. I mean, because penny stocks get driven up through newsletter, pushing, and they get driven up through little press releases or fake news or some message board nonsense or whatever, and they get pushed up, pumped and dumped. So even shorting penny stocks is not something that, is real certain. But many people just assume that the penny stocks is where they need to go. They focus on penny stocks, stocks that are less than $5. I can tell you again from experience that I don't know too many people. In fact, I can't think of a single person who has accumulated great wealth using penny stocks. I know that they say they do. I know that there's websites that talk about it. I know there's people who claim that they have done it. I've never met them. I've met a lot of traders. I've never met one. The fact is that penny stocks are cheap for a reason. You could get lucky, but you might as well just go down to the local casino, right? Because you have about the same odds of finding a penny stock that's actually going to go up and give you a massive return. Over speculation in the use of penny stocks. Am I totally against using penny stocks? No. In fact, I bought a penny stock this morning, right? I bought a penny stock this morning, but I put very, very little money into it. It was just a stock that has really strong earnings. I looked at it. I thought, I'm just gonna throw a little money at this, and I have a little, 5 to 10% of my trading capital that I permit myself to speculate. But I'm talking about people who actually use penny stocks as their primary bread and butter, right? That's a very bad idea. Very bad idea. They're highly unstable. It's very difficult to make consistent profits from penny stocks. Here's my point on this, is that if you're absolutely positively focused upon cheap stocks, like you say, Jerry, I know you say that. I know that nobody has ever made money, but I'm so convinced that I can make money doing this. Let me give you some wise counsel. And that would be if you're bound and determined to focus on low stocks, here's my advice: focus on options. Because options will give you similar kinds of prices, but you'll have access to much, much better stocks, much, much higher probability than you will investing in a stock. So buy a $4 option as opposed to buying a $4 stock, right? I know there'll be exceptions. Every now and then you'll run across a company that says, this one looks good. And that's fine. If you want to speculate a small portion, that's fine. I mean, that's part of trading. But if penny stocks make up your core list of stocks that you focus on, you will be out of business within 5 years or less. I promise you. Be very careful with penny stocks. Do not get fascinated with these cheap stocks. They have been the death knell of many, many a trader over the years. Again, if you want to focus on cheap stocks, focus on options. Focus on options. Options are cheap, but with options you have control over high quality stocks. So if you have limited capital, then think about options instead of penny stocks. All right. Number 3, this is probably one of the worst pitfalls, is that people, as we kind of said, they see the infomercials about trading and they hear all these stories about how people go out and make money, and they think they know what they're doing. And so they go out and they buy a stock, but they don't have any plan. They don't have any rule. They don't have any clue what the company does oftentimes. They have no clue what's going on, but they're just going in, right? They think, I guess, that trading is some other kind of business. And I think when you think about trading as a business, it really helps. Obviously, if you start a business, you need a business plan. Obviously, if you start a business, you got to have, some thought put into it. Trading oftentimes just gets viewed as like a hobby or as a form of gambling for some people. And so they don't think that it requires any planning. They just go out and do it for fun, right? Well, that's a dangerous way to approach trading, and that's a huge trading pitfall that will knock you out eventually. You won't be able to hold on if you don't have a trading plan or trading rules. This is where the Trigger Trade Pro software comes in, and this is really the whole thesis of what we talk about, is that you've got to have a plan. It's okay if you don't use my Trigger Trade Pro. It's okay. The point is that you have to have a trading plan. You may not use the system I have, or you may develop your own trading rules. It really doesn't matter. The point is that you have to have a plan. You have to have rules. So this is a business. So when you put money into the stocks, you put money into the stock market, you are a businessman, and you've got to make smart decisions about what you're buying, and you've got to make very smart decisions about when you're selling. And you can't just leave that to your gut, right? Because again, when you do that, you're playing chess against Wall Street and you're going to lose. So you've got to have a trading plan. You've got to have trading rules that you stick to. That means taking losses sometimes when you don't want to, right? Taking a loss on something and admitting you're wrong. Getting to the point where nothing can disturb you. We went through a couple of sell-offs back in 2015, 2016. And I've been trading for, I guess, around almost 20 years, I guess, about that point. And one of the things that I noticed about the last, and not so much in 2007, 2008, I've been trading for about 10 years, 11 years at that time. And that honestly kind of spooked me a little bit. I got a little emotional with some of my trading. And even though I didn't want to, it was almost, it wasn't as bad as when I was first trading, but I still had a little bit of emotion. In the 2015 and 2016 pullback that we saw, I had, and I guess I can brag about this. I think I should brag about this because you need to know that this is where you need to go as a trader. I had zero emotion. There was just nothing. My emotions were like steel in the fact that it was robotic to me. I did not view the market. And I tell you what, as I go back and I look at the great traders of the past, Jesse Livermore, William J. O'Neill, Gerald Loeb, man, these guys have faces like flint in the middle of Wall Street. That's what you have to have. You have to have a plan. You have to have rules. And no matter what the market is doing, it's not shaking you because you've got plans and rules. If you got to sell, you got to sell. You just do it. It's like a robot. You do what you got to do. And if you do it consistently, then you start winning. If you don't do it consistently, or if you do it inconsistently, you're going to lose. You're going to lose. It's very important that you have a trading plan and trading rules, and you stick to them. Number four pitfall. This one's one of the worst. And this one's trying to catch a falling knife, right? Averaging down. This one is tremendously seductive. Let me give you a perfect example. And I used to do this when I was first started trading. I learned after about 5 years to cut it out. It was a dumb practice. This sin is committed by so many traders, it's just ridiculous. And that is, you buy a stock at $50, right? Let's say you buy a stock for $50. And as soon as you buy the stock, it drops down to 48. Okay? As soon as you buy it, right? Some people like to say, every time I buy a stock, you want the stock to go down, I just buy it. Well, don't tell yourself that. Don't say that over and over again. That's not how you want to think. That's not true. When you buy a stock, it just doesn't always go down. Don't tell yourself that. That's a sure ticket to the poorhouse. When you buy a stock, you do your research. And if it goes down, it just means that maybe you didn't do your research right, or maybe it just went a little lower than you had expected, and that's okay because it hadn't hit your stop loss yet. Okay, let's say that you enter at 50 and the stop loss you set immediately is at 45. Okay, so it drops down to 48. And then it drops down to 47. Some people will say, you know what? This was a good idea at 50. I'm going to lower my stop loss. I'm going to get rid of that $45 stop loss because it's already down to 47. I don't want it to get stopped out, right? So what I'm going to do is I'm going to lower my stop loss to 40. And if it goes down to 45, I'm going to add more. Okay? All that sounds reasonable, doesn't it? That's the dumbest thing that you can do. If you buy a stock and it starts dropping, what do? You sell it. You sell it. You sell it. You don't hold a falling knife, right? You don't try to catch a falling knife, and you certainly don't add more. So when the stock is 50 and you buy it and it goes down to 47, and then you say, well, I'm going to lower my stop loss from 45 because I'm going to change it because the stock price changed my rules, right? You can't let the market change your rules in the middle of your rules have to be ironclad. Your stop loss cannot be changed. It can be raised, but you can never, ever, ever lower your stop loss. When you commit to that stop loss, you stick with that stop loss. That's the stop loss that you're going to use. And so you went in knowing that. You walked into the building. You knew where the exit was. Don't change the rules of the game in the middle of it, right? Because the market isn't behaving in your way. Don't act like you're right and the market is just temporarily incorrect. You have to admit, I'm wrong, right? And I tell you what, ego and pride, man, this is what enriches Wall Street. It enriches Wall Street because people just can't bring themselves to say, I was wrong. I was wrong. I made a mistake. There's something very powerful in us that doesn't want us to say that, and we fight it. And so we'll even make dumb decisions. We'll go add more of the losing stock because we're like, oh, it's on sale. But it's not on sale. It's going the wrong way. So if you buy a stock as a trader, you're expecting it to do what? To go up. If it goes down, well, you made a mistake, right? It's not that the stock market got something wrong, right? It's not that, it's just taking a little longer than you expected. You are wrong. And until you say, I am wrong, you're going to continue to lose money. So you've got to know when to say you're wrong. And whatever you do, don't compound a bad decision by adding more of the stock. I can't tell you how many times I've seen this. I did this a lot in my first 5 years of trading, and it crushed me. I cannot tell you how many times I had crushing losses because I would buy a stock, it would drop, and I was too proud. I was just way too proud to say, oh, I need to sell that stock and get in something different that's going up. Instead, I would say, well, I'll buy more because now I can buy it cheaper, right? No. In fact, all of the very best traders do something very different. They average up. So what they do is they put a little bit of their money in on the first one, right? They put a little bit of their money in on the first buy. And then when the stock starts moving in their direction, they have a second buy and they buy in. So maybe they buy it at 50 and the stock starts climbing. And they say, oh, good. It's going the right direction. I'm going to put some more money into it. I'll buy some more at 51.50. That's completely fine because you're buying it above your original price. That's fine. That is a completely fine rule. But the minute that you buy below what you paid, you are making a very, very big mistake. Now, it's possible the stock could turn around. And you can make money. That's not the point, though. The point is that you have now psychologically entered into an area where you are allowing yourself to buy a stock after it is obviously not moving in your direction. And you're adding more as it's not moving in your direction. That's a very bad psychological precedent to set for yourself as a trader. So instead of averaging down and following a stock down, you have to instead be able to say, you know what? I made a mistake. This stock is not moving. The whole market's going up, but this one's falling. It's my fault. I'm going to get out of it, and I'm going to go find another stock that's moving higher. Learn to say you're sorry. Learn to say you're sorry to yourself for making that mistake and move on. Don't hang on. Don't average down. Don't buy more as it goes lower. That's just a bad idea. Now, let me just add one more thing. That if you're a long-term investor, right? If you're somebody who says, Jerry, I'm not trading. I'm buying this stock at 50 because I'm going to hold it until I'm dead, right? And I'm going to give it to my kids. Okay, well, that's a whole different story. I mean, if you're buying it at 50 and you're buying it lower because this is just going to be a long-term holding and you're just, no matter what, you're never going to sell this thing. Okay, well, that makes sense. I mean, I get it. That's fine, and you're going to get a little more, a little cheaper. But when you're a trader, it doesn't work that way. You don't have that excuse. You can't use that excuse. When you're a trader, traders ride stocks higher, right? And if your stock is going down, you were wrong. And you've got to say, I am wrong. You got to sell it. You got to get out of the way. Don't compound the mistake by buying more of it as it goes down. Please don't do that. Oh, that's such a big problem. Okay, number 4, averaging down. Let's go to number 5 here. And we've talked about this a little bit today. And that is the topic of avoiding options. Options really are a trader's best friend. They really, really are. And in fact, we've done a lot of teaching on options, but we have some really, really great teachings straight ahead that are coming up on options. And I'm going to show you how you can take the majority of our daily trading ideas, not all of them, not every single stock that's out there is optionable. But if you have a low balance and you want to take advantage of uptrends, there's a way to do it with options that will greatly increase your probability, and it will still give you almost a dollar for dollar return, right? So when you trade in stocks, your whole point is to buy something and then sell it higher than what you bought it at. Well, with options, you get that same ability, but it's much, much less out of pocket, right? And your risk has some limits as well. So options, I think one of the biggest mistakes I've seen over the years, trading pitfalls, is that people will learn about stocks, but they stop at options. They say, no, that's just over my head, or I've heard those are risky, or that sounds like futures or something. I don't do that. I just do stocks, right? Well, I understand that, but I think that is a big pitfall for many people. Understanding options, using options regularly in your trading, even if it's simply for hedging, is a very important practice, but you have to know how to do it. So we've talked about some of the basics of options trading, but we've never really gotten down and dirty and really said, look, this is how you consistently earn from options. And that's coming. We're going to be doing a very cool teaching on options later this year. You'll be watching for it. And we're going to be showing you a lot of things I think that'll really make a difference. Don't avoid options. Keep your mind open to them. It's okay if you don't use them immediately. I'm not saying you should run out as soon as you learn to trade and start trading options. But I'm talking about in the mind. Don't have a mental block towards options. Remove that from your mind. Be open to them, because they really can allow you to boost your overall trading balance, and it really is not that difficult. It's really not that difficult. I'm going to show you what I mean in an upcoming teaching, so we'll be talking about options fairly extensively. So yeah, that's been a big pitfall I've seen for a lot of people, is that they often trade penny stocks when they should be trading options, because they think options are risky, and then so they trade penny stocks instead, right? And that's the funniest of all things I've ever heard. Or if you trade penny stocks because you think options are too risky, I mean, that's the laugh of the town, because the options are, if you structure the options properly and if you focus on the right stocks, those are much less risky than penny stocks, but they cost the same amount. So again, options, very, very powerful. We'll be going more into depth into that topic in a future lesson. All right, well, I sure hope you enjoyed that free excerpt from one of our recent premium trading coaching calls for all of our members who are pro traders. If you want to get access to these kinds of teachings, in fact, if you want to learn more about the options trading we were talking about and some of the other things that you heard, become a member, become a part of our community, and let us teach you how to prosper and profit from what's going on in this crazy economy. Just simply go to our website, ftmdaily.com/subscriptions. There you can choose your plan, and then you can become part of our community and begin getting access to many of these great trading coaching calls that we do on an ongoing basis. All right, well, with that all said, let's go ahead and dive in right now to our good friend Tom Cloud with his update on precious metals.
Follow the Money Weekly presents your precious metals market update. Here's Tom Cloud.
I'm going to mention the date that we're recording this on June 7th, 2017, because that will be important as people watch it and hear the numbers. First of all, we're 3 weeks away from halfway through the year, and the performance data so far through yesterday for the 6 things that most of you follow, the 4 precious metals that we sell, gold, silver, platinum, and palladium, and then the Dow Jones and the NASDAQ. Certainly all of them have prospered under a Trump administration, and the primary reason for that is the dollar. The dollar is being trashed worldwide, and in my opinion, no hope in sight of the dollar going up. And quite frankly, Trump's made it very plain, he doesn't want the dollar to go up. He wants our debt to get paid off with cheaper dollars, and he likes inflation because it's good for real estate, and the way he's made his vast wealth is that's the scenario he's been under. So it's not hard to see why we're seeing interest rates go up, the dollar go down, and precious metals and the stock market prospering from his politics so far. So let's take a quick look since January the 1st of those 6 investments, and we'll call them out in order of performance. The number 1 has been palladium. Palladium is up 25.2% as the world looks at Trump starting a economic prosperity and car sales worldwide increasing, especially for new cars, and demand for palladium picking up. So those that are playing that game, palladium should go higher than it is, even though it's already up 25%. Sitting in second place is the NASDAQ, not the Dow, the big stocks, but the broader stock market, and it's up 16.1%. Nowhere near as good as 25%, but 16% for less than a half a year has been an incredible run in the NASDAQ. Number 3 is gold. Gold is at 11.75% through today, as it's gone from $11.59 to $1,292, and we're seeing a shortage of gold in Asia and the Far East. And we saw China last month make one of their largest purchases in tonnage in history. As rumor has it, they're still preparing for a gold-backed currency in the next 18 months. And we've seen Dubai come out with a gold-backed currency for their citizens on June the 1st, and many people believe that it's a precursor to China watching how it's received and having parallel currencies that are fiat currencies as well as currencies that are backed by gold or partially backed by gold. And you can be assured China's watching this like a hawk. While nobody's talking about gold, it's up 11.75%, in my opinion, going much higher this year and next year. In fourth place this year is silver. It's up 9.8%, in my opinion, is lagging behind and will catch up because the same demand for industrial uses, especially the solar panels, are going to really escalate silver, as silver could be wiped off the planet Earth within 5 years if China builds and makes. We now see Tesla co-oping with to build a factory in the United States up in Connecticut to also build solar panels, and they all need silver, and we can see that silver vanish from the market. So watch this closely as silver is up 9.8%, but lagging about 2% behind gold so far. In fifth place is the Dow. The Dow Jones Industrial is up 6.6% this year. And in last place of the 6 is platinum at 6.3%. So just think, while the bond market is down this year, there are still over $84 trillion of bonds sitting in the bond market. With interest rates going up, bond yields are going down, the bond market is going down, the liquidity for bonds are going down, and we're starting to see a slight rotation of money out of bonds and fixed income and these kind of investments. And we think that trend is going to continue. And gold and silver and the stock market is benefiting from people coming out of bonds. And I think that will pick up as the economy picks up. But here's the worst thing you got to look at. The dollar's down 4%. Trump's been in office 4 months. The dollar's down 4%. But instead of gold being up historically about 40%, when the dollar goes down 4%, it's only 11.75 or 11.8% so far this year. So gold has a lot of way to catch up. And then there are the rumors, and many people saying the truth. I can't verify it, but we're seeing Goldman Sachs and these major brokerage firms now loading up on gold, and we're seeing the shorts disappearing in gold and silver for that matter. So the next question comes, when will they go long in the paper market and continue to purchase gold and silver in the physical market? We know what it looks like when they do, because we saw what year 2000 to 2012 brought was gold going up 5.5 times, and these companies, instead of going short in the futures market, they were going long. So we think we're on the cusp of these people like JP Morgan, Goldman Sachs, large companies trading their positions in the paper market, because now they bought a lot of gold, they bought a lot of silver, especially JP Morgan in the physical silver market. So now they're ready to run their investment up, and the way they do that is quit going short and accumulating it and cash in and move it forward. And we think that's going to happen. If not already, we're seeing the shorts disappear and shorts being covered in the futures market. So we do think there's a quiet time here in June and July. If history continues, it's a pretty quiet month for metals. But usually we see the last 4 months produce over 50% of the profit for the year. So we've got some real hope with the amount of gold and silver up the first 6 months, and knowing that the last 4 months historically produce bigger returns than the other 9 months put together. So we're real excited about where it is. And we're still having big trouble. And the company we're affiliated with in Asia is having trouble keeping inventory. It just comes in and it goes out. So America is still the cheapest premiums and the best place to buy physical. But how long that will be, I can't tell you. It could end in a few days, weeks, or months. But I do think you're going to see premiums going up later this year and into next year. It's going to cost you more percentage-wise to buy it over spot as it does now. And the silver deals that we've seen have all disappeared. So a lot of you took advantage of it when you could buy it 20, 30 cents below normal for that particular product. So just be ready. Gold and silver should be in every portfolio in the world. It should have anywhere from a 5 to 25% value of your portfolio, and I certainly think it's more like 15 or 20%. Money managers are starting to catch on, certainly nowhere near where they should be, but we are seeing more and more money managers in my consulting business that are coming in, talking to me, getting ideas, and seeing how it works, what I think, what it was like in the 41 years I've been in the business, what has happened. So we're here to answer your questions. We continue to have the best storage deals in the world in 5 different depositories around the world. You can call us. We can tell you about those fees. We can be reached at 800-247-2812. That's 800-247-2812. And if you want to roll some of your IRA money into a precious metals self-directed IRA, we can help you get the custodian and function as your representative and broker and work with you on the percentages. And the ones of you deal with us know our commissions are very low, 3% and below on the front end, and nothing on the back end. We work for you and get you the highest price we can get you with no fee, and we ship free to you. Just mention that you heard about us on FTM Daily. So hopefully we'll hear from you in what historically is a quiet time, but we do think there's going to be fireworks, and we do think the dollar is in for its thing. And we'll spend more time talking about the Silk Road, the trade, and why we think the dollar is headed, in addition to Trump in his first dealing with the debt ceiling, raised it $1.1 trillion, more than Obama ever raised it. So just keep the eyes on that because we know what made Trump wealthy. With this week's Precious Metals Market Update, this is Tom Cloud signing out.
Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812. All right, friends, and that brings us to the end of our program. Thank you so much for choosing to allow us into your life each and every week right here on this broadcast. And as always, I like to leave you with a final word, this time taken from the Bible, taken from the book of John, chapter 15, verse 13, where Jesus Christ himself says, "Greater love has no man than this, that he should lay down his life for his friends." It's a powerful verse, and it reminds me of a story, in fact, an email that I received not too long ago about a doctor who had operated on a little girl, just a small girl, and it turned out that she needed O-type blood, and apparently they did not have any on hand, but her twin brother also had O-type blood. And so the doctor explained to the brother that, this little boy, that it was a matter of life and death. The boy sat quietly for a moment, and then he said goodbye to his parents. He didn't think anything about it until they took the blood, and then the boy asked the doctor, he said, "So when will I die?" He thought he was giving his life for hers. Obviously, it touched the doctor, and it probably touches you as much as it touches me. Laying down our lives for others, putting others first. What a powerful, powerful verse. Just something to think about. Remember, friends, when you want the truth, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
All of the information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted